The Dow officially out of a correction after a wild day for the markets, and conflicting reports on the trade war sparking some Wall Street whiplash. Bob Pisani is down at the New York Stock Exchange to break it all down. Bob, what a roller coaster today.
And it's still not clear what's going on. The S&P rose more than 20 points late in the day on reports the U.S. is considering lifting tariffs on Chinese imports to give Beijing a reason to make deeper concessions in ongoing trade talks between the two countries. Treasury Secretary Steve Mnuchin proposed lifting all or some of the tariffs. This is according to the Wall Street Journal, which reported on this in the middle of the day today, citing people close to the matter. Now, the goal is to push forward trade talks and get China's support for longer-term reform. U.S. Trade Representative Robert Lighthizer, however, is resisting the idea, worried that it could be considered a sign of weakness. Those sources also said. Now, stocks came off their highs shortly thereafter, as our White House correspondent, Eamon Javers, said sources told him there was no talk of lifting tariffs now. So even before the middle of the day, stocks were drifting higher, and that's the key story right now. The markets have a new fear, I'm calling it FOMO, old story, fear of missing out on the rally this time. First and most importantly, the fear that earnings growth would go to zero in 2019 has largely abated. Earnings expectations are indeed lower, but most still are expecting gains in the mid-single digits rather than zero or negative growth. You see 6.1% today. Second, the market is considerably cheaper than a few months ago. Even with a 10% rally, the S&P is trading at roughly 15 times 2019 earnings. That's at the low end of the historic range, and it's well below the roughly 17 to 18 level we were at during the highs of last year. Finally, there is FOMO, fear of missing out. With the S&P unexpectedly up 5% almost in the first half of the month, fund managers are again underperforming. Now, those fund managers, remembered, underperformed last year in the down market. Now the opposite's happened, and they can't afford to underperform in an up market, getting dragged back in. Back to you, Melissa.
All right, Bob, thank you. Bob Pisani from the New York Stock Exchange. So given all this trade talk back and forth, is it truly safe to buy these dips? And what do you make of this notion that there is FOMO at this early stage in the year?
Yeah, I think there is. I think there absolutely is. No.
Well, so to me, if we get another 20 points on the S&P and you're through that 50-day, by the way, we're right there. We're right at the level where the S&P is supposed to sell off, right at the 50-day. But if you get through this, most people will say, oh, boy, I thought we were going to correct right here. In the last 3 or 4 days, remember, we've been grinding up against that for 4 or 5 days. This is a very positive and constructive sign. So you layer in the Fed, layer in earnings, banks, airlines telling you the economy's not so bad. That's FOMO.
To me, today sort of highlights that the number one thing out there is trade. Yeah. It is by far and away the most important thing, because if we do get a trade deal, not just we have that, but we have confidence resuming among CEOs who are willing to spend, and that's what's been weighing down the market. It's the most important thing, more important than the Fed.
Well, with the S&P 500 up nearly 12% from this December lows, our next guest has the ultimate trades to catch up on this rally. Let's head back over to the plaza where Carter Worth is there still.
Sure,
hey, Carter.
Thank you. Let's look at the S&P first, and then a few sort of catch-up trades, just as you've characterized it. You know, the symmetry is what's so remarkable. If you were just to, of course, look at the low there at Christmas, look at this move here and where we were at that point, it is literally same number of days down, same number of days up. But what's inherently obvious is that we are back to a very difficult level. You'll see this in many chart presentations, and in that sense, it's obvious to all, but it is what it is, a rally to a level where considerable overhead supply comes into play. People who bought poorly, who suffered a lot, who now have the chance to recoup losses and get their money back. And not only is there memory from above, there's memory from below. Whoever nailed it at the bottom, when you have quick gains like that, they itch to take those gains. Let's move to another chart, see what we can look at from here. Let me clear these, and what you're going to see is the line as I drew it, meaning an inherently difficult level. Could you press higher? Yes, but every point from here is hard fought. I think this is as good a place to start harvesting gains as any. Now, if I draw the line even further over the past year, now we get into where there's all of this in terms of overhead support, a year, of supply, not likely to work higher with ease. And in fact, the higher it goes, I think the more vulnerable it is to profit taking. And then finally, clear this, and what we have is just how steep, and I've tried to change the scale here a little bit, and where the overhead supply on a very immediate basis comes into play. So moving forward, take a look at a few individual securities. Constellation Brands, a great winner over time that is down some 38–40%. At this point, Constellation versus the S&P, I believe, has throwback potential, an instance of so bad it's good. Another instance of this, take a look at a industrial, United Technologies, again, plotted versus the S&P. And here, I think you're going to get convergence, one versus the other, whether they both go up, but UTX goes up more, or S&P down in UTX, but either way, UTX being the choice. And then finally, take a look at FedEx. An extreme situation here too, meaning there's a lot of beta in this stock. You see that it overshoots. We think this is an undershoot, and that just as there was, to some extent, mean reversion this way, the bet is that there's going to be a bit of mean reversion this way. Now, there are a lot of others, but these are as good as any.
Carter, come back on over. It's a double for Carter.
Have we ever done that before? Is this the Fast Money first?
This could be the first time in Fast Money history where I've asked the guests over the same guest twice in one show. I'm just going to let Dan ask you a question about FedEx, because he was just poo-pooing that stock. That seems to be the word of the day.
Nice.
Before.
A lot of poo. So one of the things that struck me about that whole presentation is how precise those support and those resistance levels have been. Last year was a very range-bound year, and then when they broke, they broke. All these stocks that you just have, there's clear sailing if there's reason to go back up, back to those breakdown levels. But do you think when you get there, that resistance, you may get those 10% bounces in the FedEx and the UTX and that sort of thing, but is that it? Is that as good as it
should be. I mean, that gets back to the issue. Have equities been topping for the better part of a year? They have. Remember, equities peaked a year ago in January, and even though the S&P, quote, made new highs in September, October, sector after sector failed. The financials never made a high, right? The industrials never made a high.
It was all MAGA.
Semis never made a high.
Semis never made a high. Materials never made a high. Staples, I mean, basically what you had was a thinning market, bifurcation that was resolved just as we know. And then here's the thing about, there was not synchronized global growth. What there was, all within about 72 hours, equities are high, crude oil's at $79 a barrel, and rates are at $3.30. And, quote, out of nowhere, equities plunge 20%. Oil drops from 79 to 42, and 10-year money goes from 330 to 252. Is that the kind of thing that represents a good reset, or is that a major hit that ultimately foreshadows other things to come?
I don't know. Can I ask you a different question? Those are such fundamental questions. I think if you're just technical.
Well, there are charts. There are charts. Meaning those are simultaneous. This never happened before.
So, all right, you have this level that it gets back to 2650 or so. How much of the money is worried about getting back to that level? Has that as a peg? That was their cost basis? Something. How much of the buying down at the bottom cares about that level?
A ton of it. Meaning, so there's only two kinds of buying. There's machine buying, and then there's people who don't look at machines or are doing it on their own, whether it's as a mutual fund manager or an individual retail investor. Supply overhead, right, is a very powerful principle, and it has been in effect for hundreds of years. If you, just the human condition, if you buy something at 30 and they give you 50, most people say, and that's the great sin, they give it up when they should stay, because it could go a lot more. Why give up Bank of America here? You'd say stay with it, right? But a lot of people say, I made too much money, I got to take it. So when you return to that level, the emotions get involved. I want to book it, and or the people who watch their Bank of America literally destroy them, make them think they're going to have to sell their home, and then, my God, I got my money back. That's where all of this triangulates. It's the definition of likely to be hard fought from here. A lot of people and a lot of machines are very cognizant of cost basis.
Carter, thank you.
Thank you.
Carter Braxton Worth of Cornerstone Macro. Which of the three catch-up trades do you like?
Can I do my own catch-up trade? Is that outside of the rules of this game?
No, it's not a game.
We play a lot of games on the show. A few weeks ago, we played Traded or Faded, which I finally think I've figured out. And I faded, if you recall, ExxonMobil. And I said, there's a very good chance we push down to $68. And you know what? Believe it or not, we actually got there. Now it's pushing towards 71. I bring it up because they report on February 1st. Oil seems to have found some sort of a bottom here. If the dollar is going to continue to potentially weaken, you should see continued strength of commodities. Maybe you see ExxonMobil continue to rally into earnings. So that would be my catch-up trade.
What is yours?
Well, FedEx and Constellation are two names that I've been buying over the last couple of weeks. I was a little early on FedEx. Dan talked about its underperformance, but look, what outperformed today? Transports. Look at the IYT. So if you're getting some sense of confidence, I think that's a balance sheet. That's a company that believe in. And on Constellation, look, Beer decelerated about 200 basis points. They're still best in class. This company is now very cheap relative to itself.